Perfect. That looks great, Philip. And Phil, if you want to turn your camera on, hopefully it will work now.
Hey, yeah, I'm trying. It's still not letting me. I'll jump out and jump back in and see if that fixes it.
Okay, sounds great. And hi, everyone. If you're on the call, I think this went live a bit early, but we're just going to do a quick tech test and make sure everyone's camera and audio works, and then we'll dive into the event today.
Hey Phil, try one more time. I just made you a co-host.
There we go.
Cool.
Perfect. All right, y'all look great. Philip, if you want to remove me from the call, and have a great event.
Great. Well, hey everybody. Let's just make sure the technology is there. I think we are good to go. Well, hey, thanks so much everyone for joining. This is here for another session of Links presented by Chainalysis. And I'm Philip Gradwell, the Chief Economist at Chainalysis. I'm excited to be joined today by Phil Bonello. So it's Philip and Phil bringing the worlds of cryptocurrency and asset management together. Cool. So Phil Bonello is the Director of Research at Grayscale Investments, the world's largest digital currency asset manager with more than $5 billion in assets under management in its family of 10 products. And a big congratulations to Grayscale actually for raising another $1 billion in Q3, which was announced just yesterday.
Right.
So this is a well-timed webinar because the time of cryptocurrency coming under management by asset managers seems to be taking off. And in his role, Phil monitors the developments in the digital currency ecosystem to inform product development and investor education. Prior to joining Grayscale, Phil led research at Ikigai Asset Management, using a variety of macroeconomic, exchange-based, and on-chain signals to make investment decisions. We're going to go through some of those metrics today. But also earned his Bachelor of Science in Engineering from the University of Michigan. So I'm really looking forward to your insights and our discussion today, Phil.
Thanks, Phil. Yeah, I'm excited to dive in.
Great. Before we get to all the questions and discussion, I do just want to first introduce Chainalysis to you if you don't actually already know us. Chainalysis is the blockchain analysis company. We provide data, software, services, and research to government agencies, exchanges, financial institutions, and also insurance and cybersecurity companies in over 50 countries. And it's our data platform that powers these investigations, the compliance and risk management tools that have actually been used to solve some of the world's most high-profile cybercriminal cases and grow consumer access to cryptocurrency safely. We also use our data to help you understand cryptocurrency use and the health and direction of cryptocurrency markets. That's where being a chief economist really comes in, what I spend my time on. So before we dive into the questions and discussion, I should say that this session is for educational purposes only, and it's not investment advice. If you do have any questions as we go through, please put them in the Q&A box. We'd love to have a discussion with you, the attendees, as well as just between us two. So we're here to talk about cryptocurrency metrics that asset managers and investors care about. I think before we can really dive in and ask what the metrics are, I think I have to ask, well, what do asset managers and investors care about when it comes to cryptocurrency? And for me, the first question there is, well, Phil, do you think that cryptocurrency is an investable asset yet?
Yeah, I mean, so I definitely think that cryptocurrency is currently an investable asset class. Like you said, we published our quarterly report yesterday, and right there, that shows that $1 billion was invested into the Grayscale suite of products in just one quarter, and that's 2.4 billion on the year. So, given that 80% of our investors are institutional investors, I think that's pretty good empirical evidence that demand for digital currencies as an asset class is really growing pretty rapidly.
That's, yeah, it's such a super impressive signal. Do you think there's any differences between the cryptocurrencies? You know, do you think of Bitcoin as being in a different sort of investment class to, say, Ethereum?
Yes, there are a couple different ways you can segment the digital currency space. One way that I commonly do it is by classifying them as non-productive or productive assets. So a productive asset, by holding X, you're going to get a cash flow, an exogenous cash flow in the form of Y, right? So something kind of akin to equities, real estate. When you rent out real estate, you can kind of assume a certain cash flow on that real estate. And so we see some assets that are, they have this type of structure, right? And so you can use a discounted cash flow to back into a fair valuation for some of these assets. On the other side of the spectrum, there are non-productive assets, and that's something like Bitcoin or Zcash or Ethereum at the moment. Ethereum is going to be moving to proof of stake later on. That's the goal. But right now, Ethereum is definitely a non-productive asset. And when we think about how to value non-productive assets, it's a little bit more opaque. There aren't cash flows to try to back into a fair value. And so one of the common ways to do it is just look at the supply and demand dynamics, in the market. And you can try to get an understanding of what you think a fair price may be. So we published this Valuing Bitcoin report about a month ago or so, and that went through a number of different metrics that you can look at, mostly looking at on-chain data to back into whether things are fairly priced or not. The other thing I would mention is a lot of these assets are super new, and so whether or not they're productive or non-productive, they tend to be highly reflexive, because the ceiling is so high and the floor can be so low. So you think about something like governance tokens, which has been a recent trend, or non-fungible tokens, which is relates to maybe artwork that is stored on Ethereum blockchain, right? The market capitalizations for these things is potentially in the trillions. But as margins compress, or if there's not demand, then the floor could, be much lower than we expect. So that just leads to kind of this herd mentality and hyper reflexive movements in asset prices, like we tend to see, right? So some people look at these things as more stores of value, and sometimes they look at them as like technology investments. So it kind of varies, and it depends on which area of the crypto asset market you're kind of looking at.
Yeah, so there's like a big menu of different assets that they all got these different characteristics. And as you said, there's these non-productive assets which you don't earn a yield on, but actually they've been the most established ones. And then you've got these productive assets that are a bit newer, potentially very big markets, potentially valued on the cash flows. I guess my question on that, we haven't seen those cash flows yet, which I guess is your point, that they're hyper reflexive. So when things are looking good, suddenly it looks great. But if suddenly it gets a bit more negative, people don't quite know where to put it. Which I think is my sort of next question, that how much of this is data driven versus what we call narrative driven?
Yeah, so one of the things that I've found pretty exciting in the last 6 months is the rise of kind of decentralized finance, which has been within the Ethereum ecosystem. And part of the reason I thought that's been so exciting is because some of these assets are structured as productive assets. You can look at their cash flows, and they had great cash flows associated with their tokens and associated with their projects. And so I saw some pretty good data-driven analysis, which seemed to then drive prices. But however, some of that activity within decentralized finance really started to slow down in the last month. And with that, the models showed that some of these assets were, super overvalued. And so we start to see reflexivity happen in the opposite direction, right? Where in June, July, and August, these DeFi assets really took off. Some of them up thousands of %, right? And analysts were able to kind of back into fair value for some of these assets. But in the last month, some of those cash flows have declined substantially. And with that, the prices have followed. So, I wouldn't say that this is an efficient market by any means. It's still very narrative driven. There's a big herd mentality to all of it, but it is pretty nice to see how much data is used in day-to-day analysis. And it's all open, right? So you can see everything on these blockchains. And then that's pretty refreshing. So any analyst anywhere in the world can do really, really good stuff.
Yeah, and I've always actually thought of the on-chain data giving us a level of insight that you don't have in traditional financial markets. The way that I think of it is because you can actually see people, moving the assets into a marketplace. It's similar to being able to see like the trucks full of gold turning up at a market and then moving out. So you actually have this deeper understanding of the liquidity that's actually available to be bought and sold, not just the prices that are being quoted. And I think that's something that asset managers don't understand, is the level of analysis that you can do is just so much greater.
Yeah, it's pretty impressive. And so many tools, are built around this because it's all open. So I sometimes take that for granted, but then I try to find some data relating to, something in the traditional markets, and it's really pretty siloed.
Yeah. So do you think there are any other key components to understanding that, how a cryptocurrency, say there's a new cryptocurrency, how it makes that evolution or transition into becoming an investable asset? You mentioned like there are some in the early stages that look more like an experimental technology. What do you think of the signposts to say, okay, actually now this asset might be interesting for someone who's not in crypto 24/7 to start potentially buying and getting involved in?
Yeah, so I think you can look at a lot of on-chain data, right, and kind of back into whether these currencies are actually being used. So you look at Bitcoin, you look at Ethereum, it's pretty clear that there's a lot of activity going on each of those networks respectively. And then you can dive into certain applications and certain protocols that live on Ethereum, and again, you can see that there's major usage going on, either by active addresses or by the amount of transactions that are occurring or the fees that are accrued to a protocol. I think that's a really good metric. Fees accrued to a certain protocol, and we saw that with some of the DeFi assets, and we see that with Ethereum. That Ethereum has generated significant fees. Everybody's been complaining about high gas prices, but that also speaks to the demand for usage on Ethereum. So, I think fees, if people are willing to pay for something, then it really shows true demand. Like back in 2017 when the Bitcoin prices were through the roof, that wasn't great, but it also showed that there was enormous demand for the Bitcoin blockchain, right? And so I think fees are a really good metric to look at.
Great. Before we move on to the next question, actually, on this story about understanding cryptocurrencies as an investable asset, I do want to talk a bit more about Bitcoin because it is the main asset that people really think about. And obviously it's got this scarcity. There's only going to be 21 million ever produced, 18.5 million, produced so far, probably 3.7 million of those lost. So it has this true scarcity that really doesn't exist actually in other cryptocurrencies, or if there are other cryptocurrencies that have that scarcity, they are not as popular. Do you think that is, for Bitcoin at least, the real core narrative that's driving its value at the moment?
Yeah, I think that's a huge focal point, right? It's an easy, simple to understand focal point. Bitcoin is a scarce digital asset, and that is it stands in contrast to fiat currencies, which have potentially unlimited supply. And I think that narrative has really caught a lot of wind really this year when you see kind of the monetary and fiscal stimulus that's gone on. It's really easy to understand why something like Bitcoin exists and why it's needed. I think a lot of people kind of woke up to why gold might be important this year after, like a 5-year kind of bear market. People were like, oh, gold is really valuable, especially in this regime of monetary inflation. And in a similar vein, people kind of looked at, okay, potentially this idea of a digital gold, something that has a scarce supply and can be moved across the world for $1. That's probably pretty important. So I definitely think that kind of macro story of digital scarcity, it rings true for a lot of investors.
Yeah, it's almost, if you ask the question, well, is cryptocurrency an investable asset? You've got to ask, well, are all your traditional assets that investable right now? I mean, I almost feel like we could probably cut the session, short and be like, is actually the most important crypto metric like the Fed interest rate or quantitative easing? I mean, how much do you think that asset managers and investors thinking about crypto should actually be spending their time understanding the broader macro picture?
A lot. I mean, this narrative recently has caught fire too, is that it's all one big trade, right? Risk on or risk off. And the big thing driving that trade is how strong the dollar is. So there's $60 trillion of US dollar denominated debt, right? And when we have kind of deflationary spirals, that debt pressure gets put on that debt, right? And there's more demand for dollars to service that debt. And when there's more demand for dollars, people have to sell off risk assets. And Bitcoin, equities, gold, they all get sucked into that category of risk assets. And so that's what we saw in March, right? Correlations were kind of all over the place, and you saw a lot of like risk parity funds kind of get blown up because they were assuming that correlations would stick to historical norms. And then on March 12th, correlation went to 1, and everything sold off together. I think it's pretty interesting to look at the DXY chart, the dollar index, and chart that against Bitcoin or chart that against the S&P 500, right? They're almost perfectly inversely correlated since March 12th. And to me, that kind of shows that the dollar has really been the driving force here. It hasn't been so much an issue of like what the actual asset you're looking at is. It's what's going on with the underlying asset. So everything is, or at least a lot of things are denominated in US dollar, right? And so what's going on with the US dollar, and that's driving kind of what the price movement's doing.
Yeah, I mean, I agree with that analysis. So, say you've actually just agreed, you're an asset manager, you agree with that analysis, you think cryptocurrency is an investable asset. What role might it actually have in your portfolio? How do you try and make that decision?
Yeah, it's different for everybody. Some people I know are comfortable having all of their money in Bitcoin, and others might choose to just have 1-2% more conservative allocation. Bitcoin straddles this line between being a high risk asset and being the store of value. And so I think a lot of investors who are aware of the macro environment think that's a really positive sign, right? Because with continued money printing, people are going to move further out on the risk spectrum. And so, if someone looks at Bitcoin as a high risk asset, then Bitcoin may perform really well. At the same time, money printing is probably going to be conducive to an inflation hedge, something like gold, and again, something like Bitcoin because it's scarce. So I think there are different ways that an investor can look at Bitcoin. Younger people may not have any idea what's going on in a macro sense, but they look at Bitcoin and say, oh yeah, it's just, digital money, magic internet money, and their viewpoint is a little bit different. But yeah, so that's a long answer for basically saying it's contextual. Everyone has to evaluate based on their own terms.
Yeah, that's fair enough. Just because we had a good question come in on this, you're talking about Bitcoin as an inflation hedge. We had a question from Redmi saying there is inflation in the cryptocurrency space, and that's all of these altcoins. For me, that's only inflation if you think that there's a certain amount of money that's chasing cryptocurrency as a broad asset class. And therefore, if you get new altcoins popping up, then that's as if we've increased the supply. I don't know, Phil, do you think that, if you like, there are Bitcoin investors and then there are, other crypto investors, and so actually we can treat them as two separate markets? Or do you think it's all just one pot of money just tracing, any crypto that's out there?
I think there's some of that, where Bitcoin and crypto are completely separate. I think that's also one of the really strong characteristics of the Bitcoin community, right? They won't allow anything else to enter their portfolio, into their minds. Bitcoin is the only sound money that they will rally around, and that's a really powerful thing. But at the same time, I think once a lot of money enters into the cryptocurrency ecosystem, it's relatively fluid, right? And so I think a lot of what occurred in the DeFi space was driven by people who denominate their returns in Bitcoin, right? So people who hold a lot of Bitcoin actually ended up going over to the DeFi space and chasing some of the yield that was going on over there. And I think as some of that has started to unwind, we've seen a retreat back to Bitcoin in a way. And this isn't uncommon for crypto, right? We have these cyclical patterns, alt season, which is what a lot of people call it. So I personally think that we'll start to see, Bitcoin kind of outperform for a period, and then maybe altcoins will outperform for a period. And there's always this kind of back and forth. So yeah.
Yeah. And what data do you look at to try and understand which part of that cycle we're in?
So some people look at Bitcoin dominance. I'm not sure. I'm not sure that's the best indicator. I think short-term volatility, realized volatility, is a good metric to look at. Bitcoin's volatility has been very subdued in the last few months, and that tends not to last. So when Bitcoin volatility rises significantly, then that is going to draw a lot of either up or down, right? So if Bitcoin drops precipitously, that tends to drag altcoins with it. If Bitcoin rises a ton, that tends to suck a lot of liquidity from those altcoins. So high volatility events for Bitcoin tend to be a net negative for the altcoin space.
Yeah, no, I definitely agree with that. For those of you who say go to CoinMarketCap for your metrics, then you'll see sort of a green day or a red day. That's how it sort of typically feels for people. But are there any, obviously you can look at price, but in a sense that's more a immediate indicator of what's happening. Are there any leading indicators that help you understand where the market might be going?
Yeah, so in that Value in Bitcoin report, we talked about a whole host of indicators, and some of them may be useful and some may not be useful. I kind of leave it up to the reader to decide. But I like to look at supply and demand dynamics on chain, right? And One of the indicators that I like to look at is what I call the holder versus speculator index. And so with the Bitcoin blockchain, you can categorize the age of certain coins, right? So you can see if you know a certain segment of coins were a year old and they recently moved, or 5 years old and they recently moved. And so what we can do is look at different tiers. And so for the holder side of the index, that is Bitcoin that have been held for 1 to 3 years, right? Indicating that they're kind of long-term oriented. They're not going to be buying and selling a lot and introducing new liquidity to the market. And then there's the speculator index, which is any entity that has moved Bitcoin in the last 90 days, right? So what you get is kind of this contrasting view where the holders tend to increase as the speculators decrease. And that gives you an idea of the supply and demand dynamics in the market, right? Like you typically want to see a high number of holders relative to a low number of speculators. And that is typically, if you look at previous cycles, indicative of kind of the beginning of a new bull run. And that's kind of what we're seeing right now, right? There are just a ton of holders in the market, people who haven't moved their coins for 1 to 3 years, despite all the volatility that's occurred, right? Prices have gone to 3,000, they haven't moved their assets. So the question that raises is, when will they kind of move their assets? And then on the speculator side, speculators are at a historically low point right now. So that just means that there's a small amount of active supply. And, you know, you pair that kind of with what we've seen at Grayscale, right? In the last quarter, I think there were 80,000 Bitcoin mined in Q3. To put that in perspective, we saw around 65,000 Bitcoin enter the Grayscale Bitcoin Trust. You know, so almost 77%. You know, we're just talking about proportions here. Like, yep. We're not actually giving insight on to where those newly mined coins were directed, but a similar amount of Bitcoin that were mined entered the Grayscale Bitcoin Trust, and that's a pretty remarkable thing, you know, because miners tend to be the market's natural seller, and yep. So much of that is just entering one entity, which is us, right? And so I think that's just a boon for the development of the Bitcoin ecosystem going forward.
Yeah, absolutely. I mean, you know, people think that with 18.5 million Bitcoin produced to date, Bitcoin is scarce. They don't actually realize that there's a lot of people who are holding on to those Bitcoin quite tightly. And you know, the price that they're willing to sell at is really high. And so actually, if you, as it were, want to get hold of your Bitcoin, you sort of need to do it before, I guess, someone like Grayscale sort of hoovers it up and you know, stores it for long term. You know, there's a metric that I look at, which I think called liquidity, which is how much Bitcoin has entered wallets that tend to, or on average, have only ever sent a maximum of a quarter of what they've received. So they are sinks of liquidity. If Bitcoin enters those wallets, it tends to just stay there and not recirculate. And actually, since mid-March, 1 million Bitcoin has entered these illiquid wallets, you know, these sinks. And the amount of liquid Bitcoin that, you know, tends to circulate is actually now lower than it was in mid-2017. So you really are seeing that scarcity of supply. So yeah, I think that's kind of is what is driving the current market. I mean, we're in week 12 being above $10,000, which we haven't, I think in 2017 and the start of 2018, we saw 13 weeks in total where the price was above that.
Yeah, absolutely. I think that's a great metric. I think most of these things point towards there's kind of there's a supply crunch, right? And then when you see news like Square or MicroStrategy or Stone Ridge adding Bitcoin to their balance sheet, you can see kind of the trend on the demand side really starting to grow.
Yeah. Yeah. So I guess one thing that I sometimes think about is what I call like there's a positive feedback loop, which I kind of think of as a fear of missing out loop, where obviously the price starts to rise people think, oh, okay, the price is going to continue rising because of that reflexivity that you talked about earlier. And then, people come and they buy, they take that Bitcoin and they store it for the long term as long-term investors, and that actually reduces the supply that's available. And if that reduction in supply happens faster than people are willing to sell because of this higher price, that pushes prices up even more, and that means that things kind of spiral. I guess in the same way, though, you get what I call the fear, uncertainty, and doubt loop, which is when price falls, those investors rush to sell, and it can go that other way. But I guess my question is, you could say that it's the retail customers who have perhaps been most susceptible to that type of psychology. Now we're seeing more institutional investors coming in. Do you think they are able to, hold their nerve if there was a price drop, or, how are they starting to make plans about how long they're holding for and the price they might be willing to sell at?
Yeah. So I think their institutions may be a little bit better about managing emotions, but at the end of the day, the institutions are also run by people who are emotional and who have board members who are emotional and putting pressure on them. I think that we'll still see a lot of that fear of missing out attitude if and when Bitcoin really is to break out. And in the same way that they're following, right? They're following because price is elevated. I think they may follow if price is falling precipitously, right? Yeah. And that's just the same way that that's the same thing that we see with retail. I would argue that like most of the prior Bitcoin runs were just completely retail driven, right? It's just been a retail asset, but it's the retail that enters late in the game that may not have a sufficient understanding of what Bitcoin is, why it is worth something, and those entities tend to have kind of weak hands, so to speak, right? They sell at any kind of questioning of the confidence in the Bitcoin network or in prices, whereas those holders that I mentioned before, right? The people who have been holding for 1 to 3 years, those are kind of hardened participants, and so we like to see those participants accrue a percentage of the network because they've been through this volatility and they're going to hold through volatility. Whereas, the speculators from the speculator index, they're new to the network, they're moving Bitcoin around, and maybe it's part of their trading strategy, or maybe they're just new to the Bitcoin network, but they're going to be more likely to get out of Bitcoin at like the smallest amount of doubt.
Yeah. There's actually a question from someone asking where can they find this data on the sort of holders versus short term. So you can go to the Grayscale website, and the report is called Valuing Bitcoin. We also actually at Chainalysis at markets.chainalysis.com do provide some data on the distribution of holdings across the age groups. So yeah, it's kind of these metrics are starting to get out there, which has been nice to see. Do you think, what are the metrics you really look at to understand how much of the market is being driven by institutions versus retail? Is there anything that you can look at to get a sense of that?
I think that's sort of difficult. The closest thing is looking at address growth of people that have over 1,000 Bitcoin, for example, right? So some people call that the whale index, and that's also in the Valuing Bitcoin report. And you tend to want to follow smart money, and smart money is typically large holders. And so with the whale index, you can look at the address growth of people that have at least 1,000 Bitcoin, right? So $10 million, and that metric is currently at all-time highs. you tend to see it kind of, again, cyclical with respect to these market cycles. So I think that's a really good metric. The other thing is just looking at the grayscale reports, honestly, because we've seen a huge amount of growth, and like I said, 80% is coming from institutions. So I've found it pretty impressive. It's a lot of fun to put those reports together because there is a lot of interesting data there.
Yeah, absolutely. I mean, it is, I guess, give me a pitch, as it were. Explain to me why people are looking for exposure via grayscale. And I guess a part of that is, how come grayscale has managed to offer this type of product, and we haven't seen approval of a wider range of products for people who want to get exposure to crypto but not necessarily hold the asset itself?
Yeah, so Grayscale packages these products in ways that traditional investors can understand. And Grayscale's also been around since 2013, right? So it's one of the oldest asset managers in the space. And so when institutional investors look towards the products that Grayscale offers, it's really, I wouldn't say like an easy choice, but it's easy to understand what Grayscale's offering. All of them are passive. We have one index product. Yeah, and Bitcoin is the Bitcoin Trust is an SEC reporting company. Ethereum Trust just got approval as an SEC reporting company. And so those are the only two products with that type of regulatory approval. So I think that's a big reason.
And do you think that regulatory approval is becoming, easier to get, or is it still something that's, very difficult?
It's a slow process, and I'm not sure it's becoming easier necessarily. Maybe with changes in prices, again, there will be more pressure for regulators to take a firm stance on this stuff one way or another. In the last month or so, we've seen a bunch of regulatory bodies take or make moves really within the cryptocurrency space. A lot of them have been on the harsher side. So it's unclear, kind of what that situation is going forward.
Yeah, I mean, from the Chainalysis perspective, obviously we think a lot about the regulation that's there. I honestly think a big transformation that we've seen in the last, 12 to 24 months is the real, solidification, if you like, or establishment of certainly compliance frameworks, which I think is giving people a lot more comfort that actually, the illicit activity side of cryptocurrency is, diminishing, and we actually track the percentage of overall Bitcoin and Ethereum and flows that are related to illicit activity. It's actually sort of 1% and falling, as law enforcement has got better, as exchanges have had stronger compliance programs. So that's also a key metric that I think that's there. But I think you're right, the financial regulators, I think, are starting to get more comfortable. I think, if you like, the illicit activity faces the regulation first, and then the financial regulators start to deal with it. It feels like we're in that phase where they're trying to get their arms around, agreeing to more complicated products and so on.
Hopefully.
Yeah. So I'm just going to check if there are some questions before we go into the next stage, where I want to talk a bit more about actually judging the market. So we had a question saying that unlike fiat currencies, there's a cost to produce each Bitcoin in the form of mining costs. There's the compute cost, storage, electricity, and so on. And that creates a marginal cost to mine a Bitcoin. Is that a factor that investors should actually consider in determining some sort of fundamental value metric?
Yeah, I think so. And historically, mining cost has acted as sort of a floor for Bitcoin prices. So do you want to trade, directly in relation to that cost of production? Maybe not, because Bitcoin price has historically kind of varied widely relative to that mining cost. But like I said, it tends to act like a floor. And so actually in the Value in Bitcoin report, again, there's a section that looks at miner production value. and kind of backs into a fair value for Bitcoin. But again, this is a non-productive asset, and price can vary greatly. Like I wouldn't say that there necessarily is an intrinsic value.
Yeah, and one of the things I've always worried about with that metric is, if the price falls, then hash rate can come out of the market. And so because there is a cost curve across the miners, you may actually, the cost of production for one set of mining assets is different from if actually that market changes and some mining assets exit. And so actually you can fall down that cost curve quite quickly.
Definitely. And yeah, it is self-referential, right? Because prices drop, which puts more pressure on miners, and so they drop off and difficulty drops. And so, there's a spiral associated with that. And I think people have termed that, like a Bitcoin mining death spiral or something. I don't tend to believe in that, but really, I think why that metric may work for some people is because it gives a sense of whether miners have capitulated and exited the network in the same way that you might want to look at whether investors have capitulated. So you've removed kind of like the weak hands from the market, the people who can't kind of stomach the volatility, and replaced those market participants with more hardened, well-capitalized investors who are maybe going to stick around for the longer term.
Yeah, great. Before we move on to the next section, I actually had a couple of questions, I think, about that Grayscale sort of research. I'll package them up. When you said there were 80% was coming from institutions, Spencer's interested in what kind of institutions those were. And then another question from Aaron about whether investors are actually interested at all about the fundamental sort of technology innovation that cryptocurrency is bringing, or, are they just kind of, as it were, in it for the money, or like, what's the story that gets them in?
Yeah, so on the first point, in the report, we break down the types of institutions. Majority hedge funds, people who are a little bit more comfortable with taking on some risk. We recently saw an uptick in family offices the last quarter. On the point about whether these investors are, in it for the technology or they're in it for the money, we're talking about investors. So I think that's important to kind of start with. These investors are interested in what's going on in these networks, but similar to the dollar or Netflix or any of these things that we use but don't necessarily understand the underlying dynamics of, a lot of investors are in the same boat, right? Like they want to understand what Bitcoin is and how it works, but there's only so much they need to dig into. Not every investor is actively managing their position, so they might not care about the on-chain metrics in the same way that you and I might look at the on-chain metrics. So it varies, but I think there's genuine interest, especially in the last year, kind of amid what's been going on from a macroeconomic standpoint.
Yeah, especially that, that opens up to this next part I wanted to discuss, which I guess you can either frame it as you said about should your strategy as an investor just be to buy and hold, or should you try and be more active in the market? Because people often talk about the cryptocurrency rabbit hole. There are so many different things to try and keep up with if you wanted to understand where the market is going. I guess, how would you help someone make that decision about whether they should be more passive versus more active?
Yeah, I think it all depends on what their goals are, how much time they have, is it their full-time job? We've seen, macro investors like Paul Tudor Jones, who wrote his kind of thesis on Bitcoin as kind of a macroeconomic hedge. That's one way that investors are kind of looking to use Bitcoin. Some people are looking at these digital assets as liquid venture technology type bets, right? Huge potential upside. And so if you don't have access to private markets, you might be able to get a similar sort of return on these public crypto assets. So people are looking at it that way. And then there are others who just want to buy and hold something where they come back to it in 20 years and it's still the same asset that they invested in, and hopefully it's appreciated substantially. And if not, then whatever. And so I think that a lot of investors take that approach where they may not be comfortable with Bitcoin at all, but they've heard enough about it. They've talked to their kids and family, friends, and they're like, I still don't get it, but I feel comfortable putting 1% into my portfolio. If it goes to zero, then it goes to zero. If it goes to the moon, then it goes to the moon, and that ends up protecting their portfolio overall. So it really just varies. Yeah.
Great. Just to say, do keep questions coming in because we've got about 15 minutes left. But I want to touch on an area where I think even if you're a passive investor, it's important to understand, which is, is the market sufficiently liquid for you to enter and exit? Because even if you're just going in to buy and hold, there's obviously a point you've got to buy and a point that you might actually want to sell. I guess the question I want to start with is, actually how large a trade could you reasonably execute on the open market without causing too much slippage? If asset managers are going to do big purchases, how might they go about it?
Yeah, so I was looking at some data on this just the other day. You can put in a $20 million position on the largest exchanges with less than 2% slippage, right? And that's just a market buy or sell, and that's pretty liquid, much more liquid than Bitcoin used to be, at least. And then if you're and then if you're actually trying to do that in a more kind of sophisticated way, then you can go through an OTC desk that they can execute for you, and they can put on smart order routing of whatever sort that they employ, and then you probably won't see any slippage. But these markets are trading a good amount. Depending on what you look at, it might say 1 billion to 25 billion is traded for, like, relative to Bitcoin every day. And you compare that to gold. I've seen estimates for gold around 30 billion a day. So the Bitcoin market is definitely pretty liquid. There's a lot of volume going through it. And then we've also seen kind of the derivative space heat up a lot as well. So institutional investors especially are able to kind of hedge their positions much more effectively.
Yeah, I want to come back to derivatives market just in a moment, but I actually want to ask your view on the spot market. So if you turn the clock back, I think it was maybe a year, maybe a bit more ago, there was this narrative that you can't trust the spot volumes, that what's being published by exchanges is not necessarily accurate. And personally, I think that was too broad a story. There were some exchanges that ran their data correctly, and then there's this sort of big fringe of exchanges that things were more questionable. But I think that narrative actually undermines some trust in the market. It's my sense, and I'm actually looking at the data, that really things have improved a lot in the last year. But I'm interested in your perspective on that.
Sure, yeah, and so that's why I prefaced by saying, the Bitcoin estimates of volume on a daily basis could be anywhere from like 1 billion to 25 billion, because if you look at coin market cap, the volume will show, I think, around 25 billion on the day or in the last 24 hours. And then if you look at like the real 10, which is that kind of became a standard when kind of trying to filter out some of the exchanges that were just doing wash trading. Mm. I tend to think that is a little bit too conservative, right? That's like the lower bound at 1 billion. And so maybe somewhere a little bit in the middle, around like 5 to 10 billion is a more accurate estimate. But I agree with you. I don't think the narrative should be too overblown that there's just a bunch of wash wash trading going on everywhere, and none of this volume for Bitcoin is real. It's simply not true.
Yeah, and actually, a metric that I spend a lot of time looking at is what I call the trade intensity. So it's how many, say Bitcoin are traded each day for every sort of underlying asset that comes into the exchange. And those, if you put them on a chart, those two lines should follow each other, right? Because a Bitcoin kind of comes in and then it's going to be traded a certain number of times. And actually, if you see those lines diverge, that tells you that something's going on. And we've run that metric across a lot of exchanges and seen that actually those lines tend to be what we call co-integrated. So that trade intensity is relatively stable, moving only with the market conditions, say when there's an excess of demand relative to supply. Again, like that's kind of amazing that you can actually see that in cryptocurrency. You can actually see how much the underlying is actually being traded per day, and make a judgment on the soundness of the data on that basis.
That's cool. Do you publish that indicator?
Yeah, so that's actually, if people go to markets.chainalysis.com, it's under trade intensity. We have that.
Perfect.
So yeah, you mentioned the derivative market, and as you said, like it's a big market now. I guess a big question. How would you summarize that market? What role does it play for asset managers?
I think the biggest thing is it's more capital efficient. You can get leverage in those markets. Recently, the big thing is you can hedge using kind of much more liquid options, especially with respect to Deribit. And so, I think the capital efficiency part and the ability for institutional type allocators to hedge has definitely been a positive development for the space.
And one thing that, at least when I talk to people who are unfamiliar with crypto, that sort of confuses them is in cryptocurrency, the primary form of derivative is what's called a perpetual swap rather than a dated future. The perpetual swap obviously being one that doesn't expire, like the position is just open until essentially it's liquidated because you go over your margin. I mean, I've had some very funny conversations with asset managers just trying to explain this to them. I mean, do you think where do you see the market going, especially for the more institutional side? Are they tending to go for sort of dated futures, or are they actually getting involved and trying to get their heads around a perpetual swap and manage things that way?
I'm not sure that I can speak specifically to the institutional mindset for perpetual swaps, but a lot of the time, maintaining a perp position for a long period of time is going to be expensive, right? And the cost is going to vary based on the funding rate. So the funding rate varies based on where there's more demand on the buy or sell side of the book, and that tries to really keep the perpetual swap in line with the spot market. And so if you're trying to hold a long-term position, you might want to go with dated futures rather than a perpetual swap. I think just because it's a little easier to grasp rather than looking at what's funding doing on a day-to-day basis. Because if you're holding a long position in a perpetual swap and the funding has spiked to something like 1% a day, then you're eating through your position. And that's without even talking about the leverage that you may have in that position, right? So I would think that institutional managers would opt for futures.
Yeah, that does make sense. And certainly we're seeing greater futures volumes in those dated products and also on the derivatives exchanges that tend to be sort of US domiciled and come under more regulation, which at least for me is a sign of this greater institutional investor involvement. Which I guess leads me, we're sort of running up to the end. I guess my second to last question is, how much do people need to keep on top of these day-to-day events? And we've talked about the difference between being like a passive versus an active investor, but can you really just put some money into Bitcoin and kind of come back in 10 years? Or do you think that people should be taking this more active interest to see what opportunities arise, or when there are some of these sort of big fundamental risks that might turn up?
So I think to start, like, there's probably more news per dollar in, per dollar of market capitalization in crypto than any other market, right? There's so much going on. So it can be hard to filter kind of the signal from the noise. And I probably wouldn't recommend that all investors kind of dive in face first, but there are a whole lot of really interesting developments going on in the entire ecosystem. So investors can take the approach of really trying to dig in and understand what's going on there. Some really great products that are being built that will actually target non-native crypto users, right? But then on the other side of things, I think a lot of investors feel comfortable just with Bitcoin or just Ethereum. It might align with their beliefs a little bit better, or going with an index product. So, it really depends on the investor profile and how much time they want to devote to this and how much headache they want. Yeah.
I mean, I think that is going to be my favorite new metric. The news per dollar. I actually think we should make that, because we would definitely, I think, see that being very high in crypto. But to end then, what are, say, your top 3 cryptocurrency metrics that you think asset managers and investors should care about?
Yeah, so like I said, I really like the holder versus speculator index. I'm biased, but I think that gives a really good story of what's going on in the market. From a short-term perspective and on-chain perspective, I like looking at Bitcoin days destroyed, which it basically looks at the aggregate age of all coins that have moved on chain, right? So if I sent you a Bitcoin, you held that Bitcoin for 10 days, and then you sent it to someone else, you just destroyed 10 Bitcoin days, right? I think that tends to be a really good indicator, because it shows the preference of longer term investors. If there's a large amount of Bitcoin days destroyed, then it's probably a large amount of old type of investors, old holders. That holder base has now kind of shifted over to the speculator base. So I like that. And then from a short-term perspective on just like market indicators, from a sentiment perspective, I like perpetual funding, right? So for a long time, everyone was looking at the BitMEX perpetual swap funding. When that really starts to get out of whack on the high or low side, it tends to be a pretty good counter indicator of sentiment. Okay, people are way too bullish or way too bearish here. It may make sense to go the other way. You see that similarly on the futures basis to spot. If futures are trading 20% above spot, then the market may be a little bit ahead of itself. So yeah.
Great. That's a really nice set of metrics to end on. So I just wanted to say, Phil, thank you so much for being here today and giving us your time and insights. How can people find out more?
So people can find out more going to Grayscale Insights. They can look at the valuation, Bitcoin valuation document. They can follow me on Twitter, Phil J. Bonello on Twitter. Yeah, that's probably the easiest way.
Perfect. Thanks so much. So we'll have the recording sent out via email this week, and it'll be on the links virtual landing page where you can check it out, along with our other past sessions. And we have several link sessions that we are waiting to announce. So stay tuned for a couple more sessions throughout the fall. Thank you everyone for joining us. Bye now.